All right, welcome everybody to a Monster Money trading webinar. Today we will be covering our strategy. So we have gone over the trading plan. We didn't go through it in depth. Everybody needs to create their own trading plan that fits them, their personality, their style, their time. But you will see some overlapping with the strategy. Obviously, strategy is part of your plan. So today we'll be diving in depth into our strategy, what it contains, what we look for. So let's get into it. About the strategy we use. Our strategy is day trading focused, but is based on price action and can be applied to any time frame. We are also what you would call market specialists because we are focused on and specialize in one or two pairs, as this allows you to understand the characteristics of those pairs very well. We focus on gold and GBP JPY, and these are very good volume during London and New York session when we are trading. The foundation of our strategy, we are using fundamentals and macroeconomics to understand order flow, and we are executing our trades in times of volume, primarily taking advantage of clean trading ranges or else reactions to key levels in price. Fundamentals and order flow. So I just want you guys to understand what fundamentals actually are. As I've been discussing as of late, it's more than just a red folder on Forex Factory, right? Fundamentals are macroeconomics, which may be interest rates, for instance, monetary policy, central bank monetary policy, news, human nature, and market psychology. So these could be things like greed, fear. We've seen fear being a big driver in gold as of late. We've seen greed being a big driver in US equities. So this is fundamentals. These are all fundamentals. If you're looking at the data, you may think that the stock market should be bearish, but due to human nature, right now we are still slowly moving up. So this is what is actually driving price and should be considered to some extent in any strategy, as this is essentially the only thing that we have to rationalize an irrational market. Price is not driven by technicals or indicators. Technicals are simply a tool for retail traders to visualize order flow. Following it blindly will lead to random results. So fundamentals and understanding order flow, this is a big thing and something we take into consideration every day and for every trade. Timing and volume. Timing is essential to any day trading or scalping strategy, and trading in random times will lead to random results. Consistently trading at the same time and having a consistent routine is more likely to lead to consistent results. As day traders, we rely heavily on volume and take advantage of the price movement it brings. There are key times throughout the day that are known to bring volume to the market. This is lots of orders coming in which move price. As traders, we make money on price movement and we look for opportunities in times of volume as this movement increases our probabilities of turning a profit. With bad timing and or low volume, even your best setup now has a lower probability of being a winner. Key times, pre-session, market open, and market close. These times generally bring good volume. We focus on pre-London, London Open, New York Open, and NYSE Open. One thing to note is that we like to keep our chart time to 2 to 3 hours max per session, or else you lose focus and your decision-making process starts to decline. The intricacies of London and New York session and when we execute trades. London session, when it comes to pre-London, we see gold often has very nice movement on the opening of the new 4-hour candle pre-London. So these are orders coming into the market before market open. And then when it comes to London Open, both gold and GBP JPY both see great movement in this time. GBP JPY can sometimes bring pullbacks at London Open, and this is why I prefer to stay away from this pair pre-session. When it comes to New York session, there's a lot going on, a lot to keep in mind. So we've got New York Open at 2 p.m. South African time or 8 a.m. Eastern time. And this will often bring good inflow of orders and volume to the market. There's also often news 30 minutes after New York Open. And of course, this can bring volume. Most times we wait for this news, and then often we end up even waiting for the 4-hour candle to close 30 minutes afterwards. NYSE Open is 30 minutes into the new 4-hour candle, and I like to wait for NYSE as it can sometimes bring pullbacks before seeing cleaner moves after the dust has settled. So lots going on. When taking trades between New York Open and NYSE Open, you do want to be managing risk quite aggressively, as we find that New York Open or New York session can be extremely volatile, and you can, often have price coming back against you. Like I say, I generally see those cleaner moves after NYSE, and if we're taking trades before then, we are managing quite aggressively, keeping in mind the 4-hour candle close, keeping in mind NYSE Open coming up or the news coming up. Technical analysis. We use multi-time frame analysis to build up a story of what price is telling us. We use a price action based system, so no indicators, and we are reading market structure and candlesticks to get an idea of where we could potentially see price move. We understand the importance of the higher time frames as they generally give clearer direction, and taking trades in line with the higher time frame trend increases the probabilities of the trade and generally gives cleaner moves. We take into account the weekly candles. Monthly and weekly, we're generally looking at maybe beginning of the week or end of the month, and just keeping that in the back of our mind. Looking at the daily candle close, coming into the new day, and then looking at the 4-hour candle close before London Open and just before NYSE Open to keep that higher time frame perspective. One thing to understand is that technical analysis is simply a tool for us retail traders to visualize order flow and set our entries, stop loss, management points, etc. But price is by no means going to respect the levels we set. So we make sure every trade is justified through the fundamentals as well, just to give us that extra edge. Drawing up levels and trading ranges. Levels are drawn up generally on the 15, 30-minute or 1-hour time frames at the candle bodies. Which time frame is used is situational. 90% of the time, I'm using a 30-minute time frame to mark up these levels. Candle body closures above or below these levels indicates to us that price is holding above or below a level it hasn't been able to break before. And with volume, we anticipate price to move to the next level of interest, fill or mirror the clean range to the left. Clean ranges or trading ranges are areas in price. When looking to the left, there's no immediate potential rejection areas. There's no immediate support or resistance to the left, but there is enough range. When I say enough range, this can be subjective. So just going based off visually, does it look like there's enough range here for price to fill this area and for me to take advantage of this? And will it give me a risk to reward that is sensible? Do I at least have a one-to-one risk to reward if I'm taking advantage of this range and while having a logical stop loss? So is there enough range to the next level of support or resistance that we are targeting? And we can refer to this area as clean traffic. These areas are not always going to be perfect as we can't account for every level. And this is where risk management comes in. So when we do have these minor levels, we may use these areas as management points. But as long as the 30-minute and 1 hour provide clean traffic, I'm happy and we can generally anticipate price to break through minor levels, such as levels on the 15-minute that are not present on the 30-minute or 1 hour. So just popping to a chart here quickly so that we can actually touch on, how I draw these levels in and just marking up a clean range. So for instance, right here, I'm on the hourly, going to keep it short and sweet. Right here, how I would mark up my resistance is at the candle bodies, so where the body's closed. And then we can see here this hourly candle closed above. So we closed above resistance there. In this instant, we didn't actually form that bottom wick that I would have really liked to have seen. But let's just say that we did. And in fact, I will just draw it in here just for demonstration's sake. So let's say we got that bottom wick, and let's just say the previous candle did too. Now, this candle that closed above this level, like I say, is showing to me that we are holding above this area we haven't been able to hold above before. Now, let's say this next hourly candle formed a bottom wick. All right, perfect. And we came to break this high. This is generally where I'll be entering. And I'll dive deep into the entry shortly. But just to give you an idea of what I would be looking at, this is where we could be executing those bars. And then in terms of clean traffic, we can see here on Thursday, Friday, we were in a range here on gold. We had this support level, like I say, marking up that level at the bodies. And then we can see this hourly candle close below. So there is this minor area where we could, mark this level up as a potential management area. You'll see on the lower time frames, this will probably be a support. All right, so perfect. You've got that level of support there. 30-minute, this looks very clean. So these candles right here, we would consider clean traffic. There's no level of resistance that could turn to support in this area. There's no worries for us here. It's pretty much plain sailing down to the next level of support. If there were to be a level of, previous resistance or support here to the left, this could cause issues for us. As we are coming down, we could react to that area, but there isn't. There's nothing here to the left. So we're anticipating us to come fill this clean traffic to the left or mirror this price action to the left down to the next support with this volume coming in. So that's what I'm referring to when I'm talking about clean ranges. These clean ranges present extremely high probability trades, as like I say, there's nothing really that could stop price, although like I say, markets are irrational. And we need to manage risk and be aware of those different intricacies. So entries and exits. This is a key part of any strategy, as you need to have criteria that is met for you to actually click the buy or sell button. So firstly, I just want to touch on the fundamental idea behind buys and sells. Buys are taken at support, obviously when we are trending up, or above a resistance. Sells are the opposite, of course, where we are taking sells at a resistance that is formed or below a support. So we just discussed these ideas here with those sells below support, and we just discussed the buys above resistance. But you could also argue that we could be taking sells off resistance. For instance, right here, this is a very clean setup. We'll see how this plays out coming into market open. I don't know if I would take that, but that's the idea as well behind sells. Got a resistance formed. And then, of course, buys off of a support form. So right here, we've got a support that is formed. And as you can see, we're moving up. So this is an area where we could potentially execute a bar. So like I said, that is the fundamental idea behind bars and sells. Very simply put, no need to complicate it. So for us, for entries, we are looking for candles closing above or below resistance or support on the 30-minute or 1 hour. These time frames generally give us higher quality confirmations. We can even use the 15-minute in terms of volume. The 30-minute or 1 hour candles closing to form support uh, for bars or resistance for sells. So I do like to wait when we are actually waiting for a resistance to form or a support to form. I like to see a 30-minute or an hourly closing the majority of the time, as when we are waiting for a, let's say, for a support to form when we are looking for bars, we'll generally see, obviously, we are in an uptrend, then we are experiencing a pullback. So then, for instance, right here, we were in an uptrend, we were seeing this pullback. I'm wanting a 30-minute or hourly to close bullish to give us those stronger confirmations that we are forming that support. Because a 15-minute candle closing bullish, may not give us a strong enough confirmation all the time. So when looking for entries, we also are shifting between different time frames depending on the candle closure to keep a fresh perspective and not get lost in one time frame. So what do I mean by this? When we can see that the hourly candle is coming to a close, we'll have a look at the hourly time frame, see how that candle closed. Same with the 30-minute, same with the 15-minute, especially the 4-hour. How is the 4-hour candle closing? That will give us some nice direction most of the time. So we are scaling in and out of those different time frames when those different candles are closing, just to remind ourselves of what it looks like on the different time frames and keep that overall perspective, keep that story that price is telling us in the back of our mind. You also want to take note when looking for entries of market open, news, the 4-hour candle open, because even if the setup looks amazing, you risk getting caught in pullbacks or liquidity grabs at these times if you're not waiting for these events, and you may even be right on direction, get stopped out, and then price will go in your direction. So timing is crucial. Like I say, these times to take note of can bring volatility, can bring pullbacks. So waiting for those times to actually present themselves, wait for the dust to settle, maybe wait for the new 4-hour to form a top wick, then you are left with a much higher probability setup. When it comes to exits, of course, you need an idea of when to get out of your trade. So breaks of previous candles, highs or lows, or breaks of lower time frame structure. This could also refer to risk management, which we'll touch on in the next slide. But you'll see most of the time when we are in a position, let's just say, for instance, we took bars on this candle close right here. Okay, cool. Lovely, we had that bullish candle close. And then your next candle closed doji, still respecting this resistance, but we closed doji there. So we wouldn't really want to see that candle's low being broken, because if you had to scale in here to a lower time frame, what we would see there is that we are starting to break that structure. As you can see here, we were moving bullish here, creating highs, higher lows, new highs, higher lows. And then, this may not be the best example because we moved in that direction. But what we're seeing here is when we came down to this point, breaking the previous 30-minute lows, we were breaking some of this lower time frame structure. So this could indicate to us that price is starting to go against us. You can see it maybe a little bit more clearly on the 1 minute, where, like I say, we were trending bullish there, and then we actually broke that structure. So at that point, for a period of time there, it looked like we were starting to move bearish. And in a different circumstance, we very well could have moved bearish, and we would have wanted to get out of these bars as soon as we started to break that structure, or at least manage risk. Now, the same applies if you're in profit. You can trail your stops by moving your stop loss below the previous 30-minute candle into profit. So obviously, if candles are closing against the direction of your trade, this could be an indicator for us to exit our position or at least manage risk. 4-hour candle close, market open, or news can also be exit signals, as we do expect to see or often see pullbacks or increased volatility in and around these times, which we do not always want to hold our positions through. Sometimes we'll be in a nice bit of profit, maybe have secured some of our positions, be in a risk-free trade, and we'll hold it through these times anyway, but it's all situational. Risk and risk management. So when it comes to risk to reward, we do not use a fixed RR. So no 1 to 3, 1 to 2. We don't stick to anything like that, but we rather go based off structure, and we use the logical levels in price to determine stop loss, targets, and management points. To determine if a trade is valid, I would need at least a 1-to-1 RR to the initial target. So that will determine if I have enough range to take a position in, as we were discussing earlier on. So a rule of thumb, this is obviously, where we see that overlap of the strategy and the trading plan. But when it comes to risk, we'll always address these kind of things. So never risk more than 1 to 2% per trade, and limit yourself to 1 or 2 trades per day. And this will help you to avoid over trading and over risking. Also, the more positions you take, you start to make emotional decisions. Your decision-making process starts to decline. So we want to avoid that by taking less trades, staying fresh, limiting our time on the charts. Then always aim to lose less than you planned. This refers to managing risk and keeping losses small. We also encourage a daily drawdown limit. Like I say, this is more part of the plan than strategy, but having a daily drawdown limit, I think, is extremely important and can really limit those really bad days if you could stick to your daily drawdown limit. And I personally have a daily cutoff of -3% and a weekly cutoff, which I'll start to implement at -5%. Hopefully we don't get there. Risk management. With volume, we anticipate a clean one-sided move. This will not always be the case, but as long as price respects structure, so highs or lows, obviously depending on if we are buying or selling, the trade is still valid. Breaks of minor highs and lows, previous 15-minute candles or 30-minute candles, or breaks of lower time frame structure is where we could generally manage risk by closing out a partial position or even closing out full to avoid taking the full loss. So as discussed and demonstrated previously, I have gone over those risk management ideas. We could potentially look for one more idea here. For instance, all right, I'm actually going to use this trade idea as the example. So let's just say that we executed sells on this 1-hour candle close as we close bearish. We can see now we have formed resistance right here. And this next 1 hour candle, we don't want to see us breaking the previous 1 hour candle. So that right there could be a area to potentially manage risk. Stop loss makes sense above the highs. I had the wrong position in there. So, like I say, the stop loss makes sense above these highs right here, because this is a significant level now. These are the highs that have been created. But this next 1 hour candle, that high that we created on that hourly candle right there, we could consider to be a minor level, a minor high. But with volume, we don't really want to see that high being broken, because if we do break that previous hourly high now, or sorry, 30 minutes, then we could see price moving up to this next high right here and filling that wick. So just to limit your risk, cut your losses, we could close out some of our position as we break above that previous 30-minute candle. And what you'll see is on the lower time frames is that will be some sort of structure. So right here, we had this bullish structure. So we are failing to create new highs here. These were our highs formed on that 30-minute candle. And we started to create new lows and saw that bearish momentum coming in on the lower time frame. So we don't want to be breaking this lower time frame structure. So those are areas we could manage risk. Or if we had a 30-minute candle closing bullish, or a strong 15-minute candle closing bullish, closing against the direction of our position here, that's where we could manage risk. Because if there's a candle closing bullish, that increases the probabilities of the next candle moving bullish. And obviously, if we are selling, we don't want to see price moving bullish. So it's important to listen to what price is telling you and act on that. We also manage risk if candles close against our direction, as discussed. If candles do close doji and respecting a level of interest, we may not manage immediately. So there was actually an example of this that we saw in the charts just now, where if we go back right here, we had this resistance, we had this candle close above, and then we had this 30-minute candle closing doji, but you'd probably see the 15-minute candle there closing bearish. So like I say, that candle closed against our direction here. If we were in the bars on this candle, we were in this position now with a candle closing bearish. But you can see here, if we had our stop loss below structure, we were still respecting structure, and this 15-minute candle still closed above this resistance or area of interest right here. So maybe in this instance, we wouldn't have managed immediately. And you can see right there, the next 15 closed bullish, and then we continue to move up. If this 15-minute had closed a stronger bearish candle or closed engulfing the previous 15, that would have been a different story. And that could have been a signal to manage risk. Because if that 15 had closed more like that, that doesn't look too good. And we would probably want to be out of that position. On that note, we also probably wouldn't want to see that previous 15-minute low being broken. And that's where we could manage risk as well, before actually coming down to our stop loss. So the stop loss is here simply to invalidate the trade. Like I say, if we are not actually breaking the structure, the trade is still valid. But with volume, we don't really want to see these minor areas being disrespected. So we very seldomly take a full stop loss and will generally manage our risk, manage our losses before taking that full stop loss. So that's it for today, guys. I hope that you've taken something away. Like I say, these are the things we look at. This is the strategy we use on the London session stream that you guys see. as well as New York session. And these are the things that we preach and practice. So obviously, everybody needs to find a system or strategy that suits themselves, and strategies will vary from person to person with whatever suits you and your style. But I'm sure that you can take something away, as well as at least understand what we are looking for from session to session and why we are looking for those things. So this is the Monster Money trading strategy, and thank you for watching. See you guys next time.